Well, this morning's inflation print came in cooler than expected. Consumer prices rising just 0.2% month over month, 3% year over year. Despite this easing, the probability the Fed will move forward with further policy tightening has gone down just slightly. It's now at about an 88% chance of a 25 basis point rate hike in July. That was 90%, and according to the CME FedWatch tool. So could higher for longer rates threaten the possibility of a soft landing? Joining us now, we've got Ludovic Subran, who is the Allianz chief economist, and Preston Caldwell, Morningstar Research Services, LLC, chief U.S. economist. Great to have you both here with us today. Preston, I mean, take us through your thoughts, even as we had seen this print come through earlier on and the propensity for the Fed to already signal, or at least for the markets to believe, that the Fed is going to raise at their next meeting.
Yeah, I don't think today's report was ever going to be that consequential for this month's meeting for the Fed, because the Fed's never going to overreact to 1 month's worth of data, and for good reason. However, it does provide a confirmation of our view that inflation is headed downward. And if that continues to play out, then the Fed will eventually pivot to cutting in 2024, we believe. Which appears to be the view towards which the market is moving today, with 2-year Treasury yields down about 17 basis points, which implies a substantially looser path of policy over the next 2 years.
Ludovic, will the Fed heed this data? In other words, this is 1 month. We have seen the trend improving. Is there still a risk of a so-called policy mistake here?
Look, I mean, one thing is sure is that the Fed will not get derailed by 1 month at 3%, right? Because there's a huge base effect, and somehow it's still 3%. And the last thing is we still see the transmission, the pass-through. Shelter is now the last domino of the game, right? So I think the Fed will hike in July. There is absolutely no doubt. The real question is whether they will hike again in September for me. The reason for that is because, when you look at the monthly rates of inflation in the U.S., even with 0.2 or 0.3 on month, which is not a lot, you still get, close to 4% by year end. So it's still too much. And so, yes, there is a risk of a policy mistake. There is a risk of manufacturing the recession and the hard landing. And remember, the numbers, and we're going to see that in the beige book, I guess, is the financial and monetary conditions in the U.S. are getting super tight. So the problem here is to understand what is the risk here that they keep rate high too long, and that this trickles down to the real economy.
Just to follow on that, does that mean that the Fed doesn't need to kind of enact policy all the way until 2% is struck, or do you believe that there should be just kind of some waiting and seeing to see where the economy, where inflation specifically, can get down to their target without having to forcefully do so?
Well, I believe something is sure: transmission uncertainty is high. The lag effect of monetary policy to the real economy is a bit tweaked because of many things: excess savings, the order books, the massive transfer of wealth from the public sector to the private sector, and so on and so forth. So I think the problem here is this dislocation is creating a bias for the Fed to wait out a bit more because they don't want to be uncredible with their mandate. So that's why this data dependence that is in every central banker's mouth is, for me, a policy making a mistake, because the role of the central bank is to provide forward guidance. So first, we risk a high correction on the market, a 22 type of event. And second, by the time we see the full transmission, it's going to be too late. So if you pivot too late, then you're going to have a jobs market issue. And so that's a bit the trade-off that the Fed has to face. Is it really worth it going all the way to 2%, but have 6% unemployment rate? Or is it okay to be in a 2 to 2.5% range and you are good with 4% unemployment? And that's something that is not being discussed enough as we speak here.
Preston, do you agree? Do you think the Fed needs to be more transparent about that trade-off? I mean, it's interesting because it feels like Fed Chair Jay Powell has been fairly, I don't know if cagey is the right word, right? But perhaps not willing to acknowledge the full extent of damage that the Fed could potentially do.
Well, a few points. First off, I don't necessarily agree with the nature of the trade-off. I do think by 2024, early 2024, inflation will be approaching 2% in year-over-year terms, even without a severe recession. But supposing that the trade-off is true, I do think, the Fed is very reluctant to deviate in its rhetoric from its adherence to its 2% target, and for good reason. I mean, the very fact that people in the economy believe that the Fed is adhering to a 2% target may be crucial for inflation eventually returning to normal. So I don't think there's anything wrong with the Fed being a bit cagey on this point. For now, the Fed still needs to stick to 2% officially.
What they have discussed, at least as apparent in their own meeting minutes here, is a mild recession starting later this year, followed by a moderately paced recovery here. What is the reality of what a mild recession might look like from your purview, Preston?
Well, first off, I would say, whether we get a recession or not is, especially if it's a mild recession, it's not really that important, because I think we're headed for a growth recession. In any case, even if we don't call it a recession or not, we're headed for a period where growth is below trend, and below trend growth is all that's required to provide deflationary pressure throughout the broad economy. So there's no light switch that is turned on whenever you go into recessionary territory. The fact that the economy will slow down over the next year, and also that will reach into labor markets crucially, which it really hasn't thus far. Labor markets are still expanding fairly rapidly at a robust pace. All of that will help to cool off the broader economy over the next year, whether it happens to be officially declared a recession or not.
Ludovic, do you think it will? What's your outlook at this point on the soft versus hard versus when and what this recession could look like?
I don't think there is such thing as a soft landing. I think this is rhetoric. I think, every tightening cycle ends up in a recession or in a financial crisis, historically. So why would this time be different is, I fail to understand some of the observers that think that this time it could be different. I'm sorry. I think I agree with Preston that there is this purgatory of growth for the U.S. The U.S. has not created enough growth. Most of the gains in the U.S. economy are very concentrated to a few stocks, in the financial markets. But for the average people, there is not a lot of growth, right? The only reason why the labor market is resilient is labor hoarding, because a lot of people are waiting for fiscal stimulus. But we are heading to an election year. And remember 2016, remember other years where you have this muddle through, which is not very good for the bottom 10% of the population, the bottom 20% of the population. So for me, recession or no recession, you call it the way you want. It's not good. It's not good because it's going to be the same people that are going to be affected that have already paid the very high price of the cost of living crisis. So I'm a bit concerned, I would say, about the social compact. And that's why it's going to be a litmus test for the Fed and its political independence to be able to maintain rates all through 2024, at a high level without pivoting. I think I don't think materially you start seeing a bit some of this deceleration in the very cyclical sectors. And so I do not see why labor markets would defy gravity with this level of interest rate and this, interest burden on agents, households, companies, and also the government.
Gentlemen, really interesting discussion. Thank you very much. Ludovic Subran, who is Allianz Chief Economist, and Preston Caldwell, Morningstar Research Services Chief U.S. Economist. Thanks to you both.